How does an advisor evaluate what an appropriate level of fees should be for a mutual fund?
For us and for anybody rating funds, certainly it depends on the category of the fund. So certain kinds of investing is simply more expensive, emerging markets, as opposed to, say, short-term government bonds. So you do need to consider what the fund's investing in. That said, you also need to consider how much money you bring to the table. Institutional investors, those who can invest millions of dollars, are going to get more favorable pricing than a individual investor. But within those constraints, you can certainly look to a peer comparison group and find funds that are rated high expense or low expense or somewhere in between. Again, the issue with expenses is whereas performance is cyclical, it goes up, it goes down, it's good, it's bad. Expenses are always a detraction from returns. It's mathematics. It's not an unknown, it's a known known.
So there's been some discussion about advisory fees on mutual funds being used for distribution expenses.
Sure.
Is this a concern for investors? And if so, what should they do to account for that?
Sure. There's often a lot of confusion around fees and what they're paid for, and it doesn't help that fees often have confusing names like custodian, transfer agent, 12b1 fee, and so forth. But what's especially problematic is when people are paying money which they think is going to the management of their fund, to those research analysts they see on TV from foreign locations or people who seem to have insights in the bond market, when that money is instead going to pay a platform or a supermarket or some other place where the funds are sold so that the fund can get additional distribution. Now, additional distribution can come back to the benefit of the investor because, again, scale can equal lower fees in the long run. However, it is by law very clear that distribution fees are supposed to come out of a specific bucket, and they're not really supposed to come out of the advisor fee that the investor pays. Now, if the fund company wants to pay money to get its funds somewhere, that's fine. That's coming from its own profits. But the fund is supposed to be run for the benefit of the shareholders, not for the benefit of the advisor. And so the money they're paying for an advisor fee really should be going to pay those investment analysts and their research and their trips to visit companies and things like that.